The 9 most frightening words in the English language are, I'm from the government and I'm here to help.
Happy New Year, everyone. There has been a recent wave of a phenomenon called populism, an ideology that rhetorically emphasizes the idea of a common people being screwed by Machiavellian elites. This idea is quite broad, with positions appealing to both the left and the right. From opposing wars, weariness of political correctness, regulating big tech, advocating for protectionism and trade, and concerns of civil liberties from law enforcement agencies. Two main aspects of populism that has personally fascinated me has been social conservatism and economic leftism, as well as their intersection. One man that might be able to represent this is Senator Josh Hawley. As a socially conservative Republican, while he's not a diehard fan of outright socialism, has taken at least a few economically left-wing positions, which is quite significant for the party of laissez-faire capitalism. One of his more recent positions is opposing so-called usury, or excessive interest rates. Interest rates are the cost of borrowing and reward for saving. They are charged by financial institutions like banks for certain products such as loans, but not everyone likes interest rates, or at least think they can be too high, as you will see in this video, so they may advocate for something like, say, interest rate caps. This is when the government places a limit on the level of interest that financial institutions can charge. So if there is a 5% interest rate cap, then a bank can't charge more than 5% interest on a loan. Anyways, a few months ago, Josh Hawley introduced a bill that can be called Capping Credit Card Interest Rates Act, which would cap interest rates for credit cards at 18%, including finance charges, and fees that aren't finance charges would not be excluded from the limitation. That last part is a little important later on in the video. Anyway, the motivation for this has been record high credit card rates within the US, where the average credit card rate has been slowly reaching 21% at the time of the bill proposal, and Americans have a total of $1 trillion in credit card debt. Hawley also saw it unfair that banks such as Silicon Valley were bailed out, which is a fair point. But two wrongs don't make a right, since interest rate caps will actually hurt consumers. Libertarian political pundit Brad Palumbo understood this well. When he saw Hawley contradicting the Republican Party's principles of limited government, he responded with an article where he decried populism and Hawley's proposal of limiting interest rates. But it got picked up by two major online political commentators who couldn't be more different. These are Michael Knowles and Shoeonhead. Michael Knowles is a conservative commentator from the Daily Wire, an American conservative news media group, while Shoeonhead is an anti-sjw YouTuber who is, at least the last time I checked, a socialist. When Brad tweeted his article, Shoeonhead sarcastically replied to the tweet with, literally communism, the most likely implication being that Brad is being overdramatic and is attacking more moderate interventionist methods to help the poor. Of course, she for some reason failed to show Brad's argument for why interest rate caps were a bad idea in his article. But a more notable response was from Michael Knowles, who talked about various historical figures, some linked to Christendom, who were opposed to high interest rates or usury. Of course, Christianity and interest rates aren't necessarily at odds, since Jesus talked about how a servant was wrong for not taking advantage of interest rates in a parable. While this doesn't necessarily prove that Jesus approved of interest rates, since it was a metaphorical story, you would expect him to be more negative towards it if Christianity disapproved of it. Also, the situation of people being loaned interest was a different situation historically, according to this fee article that a pretty cool YouTuber told me about, called The Political Checkmate. His channel is linked below, but I will save all of this for another video. Brad points out that Michael, Hawley, and Shoeonhead think the populists are too stupid to make their own financial decisions, but this fell on deaf ears for Mr. Knowles. You know, it's actually interesting how this issue united two different pundits for either religious or economic reasons, and that is the bipartisan appeal of populism, particularly conservative populism, though I'm not sure if Knowles would consider himself a populist, and Shoe is definitely not a conservative. So how am I going to prove my point? If only there was a concrete way for me to empirically show why limiting interest rates suck, and debunk the validity of Hawley's policy, something that I am used to and... Okay, if I'm going to use a study to debunk the feminist argument that mere women leaders means world peace, then I'm definitely going to use a study that analyzes capping interest rates and its economic effects. There's this World Bank study that analyzed 76 countries that has some form of an interest rate cap. As this study looks into countries around the world, there is a term called microfinance. Microfinance is a small amount of financing for low-income individuals in developing countries, with loans ranging from $50 to $50,000. The typical loan is in fact $100, which seems small but not in the developed world, especially since this is often enough to start or sustain a business there. They have a focus on helping the unemployed, poor or women, to help them escape the trap of poverty. It is a term used quite a lot in the study since interest rate caps have affected these type of loans. Now, interest rate caps appear to work in South Korea, while financial liberalization seems to have no effect. But this seems to be the exception, as there is no further evidence of this argument working. Other evidence instead shows that interest rate caps are ineffective at lowering interest rates, especially in the long term. In fact, there's evidence that interest rate caps limit access to credit, reduce transparency, lower product diversity, and cut competition. But why? Well, as financial institutions like banks need to make sure that the person they are providing a loan to is able to pay it back and also need to somehow compensate themselves for not having that money for a period of time. They use interest rates as a mechanism to solve these two problems. If a borrower is riskier, the higher interest rate can discourage riskier borrowers or at least compensate the financial institution for the higher probability of default. And if a bank loans a large amount of their money, like say $50,000 for 5 years, they won't have such a valuable amount of money for some time that they could have instead used on other projects. The value of that $50,000 will also fall due to inflation, which is why interest rates can be raised to reflect the bank's opportunity costs. But if you artificially limit these interest rates, financial institutions will be less likely to be able to compensate or mitigate potential losses. The benefit of giving a loan to a low-income or high-risk borrower is that the higher interest rate can compensate the bank for the risk. But capped interest rates means lower interest rates, and a lower interest rate decreases the incentive for banks to loan to low-income or high-risk borrowers. Therefore, these caps will cause these institutions to more likely lend to clients with higher collateral. In other words, there is less available money in the form of loans for people who need it the most, yet have fewer alternative sources of credit. For example, lower caps on interest in Japan caused the supply of credit to decrease, and acceptance of loan applications fell. These interest rate restrictions have also reduced access to credit in Poland, as well as exclude many low-income and high-risk borrowers from credit in Germany. Even when financial institutions can be profitable with interest rate caps, these restrictions can cut investments in new markets, possibly due to lower overall profit, or that loaning to a certain group or creating a new product isn't profitable under the new interest rate. This is evident when the interest rate caps in Colombia were hurting small firms due to high transaction costs, so when these caps were loosened, it led to a higher volume of microcredit lending. In more extreme cases, when interest rate caps are set at unprofitable levels, banks and microfinance institutions may leave from certain locations, such as rural areas or expensive market segments, as they are unable to cover their costs. For instance, within the WAEMU countries, caps on microfinance loans cause microfinance institutions to withdraw from poor and more remote areas, while also increasing the average loan size to improve efficiency and returns, while in Nicaragua, these caps similarly cause microfinance institutions to not only reduce lending, but leave rural areas due to high operational costs and risks. When you take into account that these ceilings on interest rates causes low-income borrowers to have less credit due to less financial institutions wanting to lend to them or that they leave their areas, this means that in some cases they are left with few options for borrowing in the formal market. This means they could turn to unlicensed moneylenders, and these moneylenders will probably charge a higher interest rate. This was the case with Japan when low caps on interest rates increased illegal lending. These caps also discourage finance NGOs and others from converting to licensed financial institutions, such as with Bolivia where maximum interest rates introduced in 2004 caused a fall in licensing of new lending institutions. This rise in illegal lending and lack of licensing is actually a harrowing situation when you think about it, since getting into contact with illegal/unlicensed lending can increase the chances of dealing with aggressive loan sharks who will be quite violent if borrowers are unable to pay. I know people who won't like this video will complain about so-called usury from licensed banks, but interest rate caps don't eliminate usury. It merely forces consumers to suffer from loan sharks who will charge exorbitantly higher rates who could harm you if you don't pay up. Actual usury. Moreover, financial institutions withdrawing from certain areas has other unintended consequences. When interest rate caps lead credit suppliers to withdraw from the market, this decreases competition since there are less financial institutions in the market, meaning less options for consumers. This fall in competition leads to a narrower range of products / less product diversity, as well as less of an incentive to innovate. For instance, in France and Germany, interest rate ceilings decrease the diversity of products for low-income households. When caps don't cover fees and commissions, and when the definition of interest rate is not clear, financial institutions may charge fees and commissions that are not a part of the loan, yet seem to be compliant with the cap. This was the case with South Africa, where they charged credit life insurance among other services to evade caps, as well as Nicaragua, where financial institutions added fees and other charges to cover their costs, since these were not capped. While in Armenia, as there was a lack of clarity to calculate the interest rate, this led banks and financial institutions to charge fees and commissions which helped them avoid the cap, but create a lack of transparency for consumers. This last point would probably be a big reason why Josh Hawley's bill made sure that fees could not evade his interest rate caps. Though, as I said before, while his bill might stop these fees, the banks will probably decrease their level of services if the cap were implemented. Finally, if we look at America, where Josh Hawley wants to implement his policy, the evidence is more mixed. One US study in 2003 found that financial liberalization, such as the removal of interest rate caps, positively affected small firms' access to finance, while another study in 2006 discovered that clients migrated to states with less restrictive lending. In mid-19th century New York, interest rate caps increased both illegal lending and the average size of the loans, like I mentioned previously for other countries. Within the US credit sector, access to credit for high-risk borrowers is greater when interest rate caps are higher, but the higher cost of credit increases the probability of default. In addition, interest rate caps in the US credit union sector lowered interest rates, but the credit supply decreased. Now you may say that it's the greedy bank's fault for acting this way, for charging fees, for cutting the services, for leaving, for cutting investment. But this doesn't take into account incentives. Banks are like everyone else. They are self-interested and will take any action to minimize costs to get the most optimal outcome. Anyways, if you like the video so far, please feel free to subscribe and like this video, since I would love to get to 500 subscribers by 26 January, since on that date I would have been doing YouTube for 4 years. Now, since interest rate limits are a disastrous policy, the authors of the study recommended some alternative policies to help consumers deal with credit. Number 1. Competition. More competition can really lower interest rates, and this could be done by opening branches in new areas, cutting loan times, making loan times flexible, and allowing microfinance companies to provide savings products. This has been empirically proven with Bolivia and Cambodia. In Bolivia, Banco Sol was able to lower its costs due to a competitive environment and pass on these cost savings to consumers in the form of lower interest rates. While in Cambodia, interest rates fell within the microfinance sector, and this led to lower interest rates on loans charged by informal moneylenders. Number 2. Financial consumer protection. Financial consumer protection was suggested as a way to protect consumers, especially the high-risk kind, and force financial institutions to consider all the risks, and the framework for this should be based on transparency on interest rates and related costs, guaranteeing fair and non-abusive business practices, a mechanism for setting complaints, protection of personal information, and trust in financial institutions. This framework should also provide financial education, which brings to our next point. Number 3. Financial consumer literacy. Financial education can help consumers to make better financial decisions, especially for lower income groups. This can involve organizations such as mass media, financial institutions, and government agencies in tailoring these programs to specific groups. While financial literacy is positively associated with higher incomes, there is apparently limited evidence between financial education and access to finance. In China, this training allowed farmers to take crop insurance, which spilled over to their peers. While in Indonesia, this financial training only allowed a small number of people to open bank accounts. Regardless, this is a policy I am personally in favor of, and to implement it within schools. Number 4. Credit information. Other useful measures are improving credit information systems that can mitigate high interest rates, like credit bureaus and proper disclosure of interest rates to improve competition. For instance, when Cambodia launched a credit bureau in 2012, it lowered lending costs. Also, properly disclosing interest rates allowed better information of these rates for consumers, and the competition that arises from this will lower interest rates. Legal measures that ensure transparency and knowledge of interest rates can help since they are positively correlated with higher financial depth. Number 5. Microcredit products. Microcredit products could smooth consumption, empower women, and cut poverty. Or dispower women, increase poverty, and hurt children's education. The evidence is mixed, which is why the solution should be approached with caution, by accompanying this with regulation and financial literacy. Number 6. Interest rate caps. Now, if for some reason an economy must still use interest rate caps, then the final recommendation suggested is to use these caps on certain products, like consumer loans or certain institutions like microfinance, rather than the entirety of the financial sector. Now, many of you might say, but Jerusalem, didn't you say these caps have had negative effects like a lower supply of credit? And I will respond to you, why yes, and it's Jerusalem, you Yankee bigot. But the study provided no empirical evidence that these caps could be isolated to a few sectors, or that they help. It appears that the authors just wanted to limit it a little as possible instead, especially since different sectors and products require different optimal interest rates in the market. So what is excessive would be different for various financial products and loans. Other caveats for these caps are that the cap should be defined properly, including its costs of credit such as fees, and absolute caps would be preferred to relative caps for a specific type of credit provider. P.S. Absolute caps would be like 18% max interest rate for a loan, while a relative cap would be like an interest rate not going above 5% over the average interest rate of financial products charged within a country. They also want the cap to be set at a quote-unquote reasonable level, but I doubt central planners will be able to easily calculate the optimal interest rate based on thousands of price signals and information within the market that moves at such a rapid pace. Now, in terms of these policies, I don't know if they will work, and I'm definitely biased against some of these since I prefer a hands-off approach to the market, but they are way better than capping interest rates. Anyways, thanks for watching. I'm hoping to make more videos this year, and I'm also hoping to release my first video of a series called Debunking Bidenomics, which basically debunks some of President Biden's economic policies and ideas. If you like that sort of thing, then please subscribe, and like and comment this video to help it in the YouTube algorithm. Thanks for watching, and see you later. Bye.